Let me tell you about a bit. Let me tell you about a client I talked to recently. They had two businesses. One was a vocational training school that taught people how to do nails, and the other was a driving school. And on paper, this made sense to her. They're both schools. It's one tax return, it's efficient, simple. But when we started talking about the insurance, it got complicated fast because the professional liability insurance for a vocational training school to do nails, not that risky, but a driving school, totally different ball of wax. The insurance doesn't just see one business, they see the riskiest operation in the suite of companies. And if you're grouping businesses together the wrong way, you may have a very negative impact on a business that is potentially very low risk and could get low rates because it's being lumped together with something that is much higher risk that's going to get much higher rates. You may be working against yourself. So let me explain why this happens and how to think about structuring your business so insurance works for you and not against you. When underwriters look at your business, they look at the entire entity, not just your intent. They're not really concerned about what works well for taxes and what your lawyer's telling you to do. They are looking at your operations and they are measuring how risky it is, whether it's for general liability or professional liability or abuse and molestation, any part of your operation. They're going to break it down to its nuts and bolts. So let me talk to you about a couple of different combinations I've seen over the years that have worked against the business owner. I told you about one where the business owner had a vocational training school for someone to paint nails and a driving school. The driving school is incredibly risky. Painting nails, not so much. If the nails, if the vocational training school for nails was on its own, that wouldn't be a big deal. But because it's lumped together with the driving school, it's a problem. Other things that I've seen a person that runs zip lines and then manufactures harnesses. They're both incredibly risky, but they're very different types of risks. So the zip lines, you're very worried about premises liability. You're worried about somebody falling off. For the harness, you're worried about product and completed operations liability because that's a manufacturer's risk. And you try and put both of those two things together. It's hard enough to find one of those on its own, let alone trying to find one company that wants to do both of those things. Or let's go a little bit simpler. I've got an, an organization that will do a little bit of mold remediation work, but then does a fair chunk of janitorial work. So here's the thing. Mold work is considered to be very risky and will bump you out of of underwriting oper- a lot of underwriting appetites because they don't feel like they've got the appropriate pollution liability. The companies that would normally do janitorial work really didn't want to touch it because they wanted nothing to do with the mold remediation work. I mean, here is the rule of thumb. The riskiest work in your portfolio of companies is going to be the anchor. That's the thing that the underwriter is going to look at first. And if you don't want that, you need to make sure that your portfolio of companies is structured and set up in a way so that it won't be the anchor. Because insurance is underwritten to the worst case scenario, not the average one. That's how underwriters think. They are going to look at their box and their underwriting guidelines for a janitorial business. And if they see mold remediation work, it's out, which means you're automatically going to the companies that will underwrite for mold remediation work, which charge more, they charge more, they don't offer coverage terms that are as good, and they don't offer financing plans most of the time. You shoot yourself in the foot just a little bit. This is why I spend so much time talking to business owners about how they have their family of companies structured. I am interested in how they've set up their different LLCs, their corporations, if it's a social enterprise, their for-profit and their nonprofit, because your accountant may be looking at one thing, your lawyer's looking at another thing, but from an insurance perspective, my job is to make sure the way you have structured your operations is not going to break your insurance and that you're going to continue to be marketable. So if you own multiple businesses, you're running multiple operations, you need to make sure that what you are lumping together fits together. They should look similar. They should have similar ethos, similar operations. If they are too different, it's going to make it very complicated for you to place the insurance. If this business helped you see your business differently, hit subscribe, hit like. It helps other people like you find the content. I make these videos so business owners can spot problems before they become expensive surprises. If you want to talk to me about your program, my contact information's in the description. You can drop comments. I answer all of them. As always, thank you so much for watching. Please go build something great.